Thank you guys so much. Welcome to today's session. Thank you for making time wherever you're coming from. I am currently in California, although I am part of the Arizona Council. So today's PD session, the tools of monetary policy have changed, has your instruction, is brought to us by our friends at the Federal Reserve. We'll introduce them in just a moment. But it's fantastic to see so many fellow NAEE members here this afternoon. I'm going to give you just a few logistics of the meeting and then I'll turn it over. So for those of you that don't know me, my name is Kathy Pondy and I am the NAEE Professional Development Committee Coordinator. So thank you to all of you that have brought ideas or work on that committee. This idea was brought to us by Scott and we're so excited to be able to make time to bring this to you. I am the Director of Student Programs and Community Relations for the Arizona Council on Economic Education, and happy to coordinate this. So we have an hour planned, and please feel free to use the chat if you have any questions and comments during this session. I know that there's fantastic information being brought to us today. We will be recording this and posting it on the NAEE YouTube channel for anybody that might need to leave early or for those that couldn't attend today. So I encourage you to turn your cameras on if that works for you. If you want to put your organization's name in your naming area, that'd be fantastic if you'd like to. So now I'd like to introduce our presenters. We have Scott Walla and Jane Eyrig. Scott is the Economic Education Coordinator for the Federal Reserve Bank of St. Louis. I'm sure that many of you have had the pleasure of using lessons created by Scott or perhaps attending previous trainings provided by Scott. And joining Scott today is Jane. Jane is a senior advisor at the Board of Governors, Jane Eyrig, at the senior advisor at the Board of Governors of the Federal Reserve System. Jane has over 20 years experience as an economist at the Fed and is a published author on monetary policy implementation. And we're very lucky to have them here today. So Scott and Jane, I'm going to go ahead and turn things over to you.
Thanks, Kathy. So thanks for joining us today. The tools of monetary policy have changed, and we're here to ask, has your instruction? We also want to remind you that our views are our views alone, not those of the Federal Reserve System, the Federal Reserve Board of Governors, or the Federal Reserve Bank of St. Louis. And Kathy did a great job introducing us, so I think we can skip through this slide. But we do want to start with a poll. So let's start with this question. What is the Fed's primary tool for influencing the federal funds rate? And I think Kathy has a poll she's going to launch here.
Yep, I'm relaunching it now. And so Scott, can we see that?
Yep, looks great. So this is where if I had the Jeopardy, Final Jeopardy music queued up, I'd be playing it. So you can imagine it playing in your head. We're at about 20 of 26 people voting. All right, so let's see. I'm going to end the poll. And there we are. So we are at open market operations, got 35% of the vote. Discount rate, 26% of the vote. Reserve requirements, 4%. And interest on reserve balance is 35%. I am just writing this down so we can do a pre-post to see if your answers change over the course of our presentation. I'm going to close this. There we go. So let's take a stroll back in time and talk about what was happening in 2008. So if you think back to this, you might remember George W. Bush was president of the United States, finishing his second term. You might remember that superhero movies were big. The Dark Knight, starring Christian Bale and Heath Ledger, was a top movie for DC Comics. In the Marvel Universe, the Avengers story was just starting to be revealed with Iron Man. And Pixar's WALL-E showed how a movie with very few words could still charm us. And 2008 as well was an election year. Barack Obama, U.S. Senator from Illinois, was running for president. His running mate was a guy, Joe Biden, who was a U.S. Senator from Delaware. And you might also remember that there was a financial crisis going on. In fact, it was a global financial crisis. Stresses in the financial system built up gradually over 2007 and 2008 as mortgage troubles and recession fears increased. The stock market peaked around mid 2007 and fell through 2008. And then there was the housing market. After rising rapidly for nearly a decade, housing prices peaked nationally in the summer of 2006 and then fell rapidly. And since much of the wealth of households is composed of their stock market assets and their home, most Americans suffered a large decrease in household wealth. Also in 2008 was the last year that the Fed stopped using its old toolbox, which relied on the old tools, open market operations, the discount rate, and reserve requirements. So let's do a little bit of review and talk about how the Fed, in that limit, we call it the limited reserves regime, how the Fed adjusted interest rates using that old toolbox. Okay, and this is a graph that is probably familiar to you. There are similar ones in almost everyone's textbook that they're using. So here's a quick review, right? So prior to 2008, the Fed was operating with limited reserves in the banking system. In that framework, the Fed's toolbox worked like this. So you see the federal funds rate. The federal funds rate is determined in a market. And as you can see in the graph, we have a supply and demand graph that represent the market for reserves in that federal funds market. Reserve requirements created a steady demand for reserves that's reflected in the downward sloping demand curve. Eventually, it flattens out at the bottom because at some point, banks don't need any more reserves. And then at the top, it flattens at the top because the discount rate caps that demand curve. Banks shouldn't be willing to pay more for reserves than they can borrow at the Fed's discount window. So the discount rate caps that demand curve at the top. And then there's the supply curve, right? So the Fed controls the total supply of reserves, and as a result, the Fed had the ability to shift that supply curve back and forth using open market operations. Okay, and you can see in this little diagram as it animates that a very small shift of the supply curve can be effective at lowering the federal funds rate. And so, again, when the Fed wanted to lower the federal funds rate, it would do an open market purchase of government securities. It shifted the supply curve to the right. And as it shifted to the right, the federal funds rate would fall into the Fed's target. So just as a summary, the FOMC would set a target for the federal funds rate. And then the Fed, the trading desk at the New York Fed, would conduct open market operations and guide the federal funds rate back towards the target. But then something changed. And with that, I'm going to pass it to Jane.
Thanks, Scott. So as Scott mentioned, what changed? It was the global financial crisis. And the global financial crisis is what spurred the Fed to start thinking about a new implementation regime. So at the global financial crisis, as Scott showed, household wealth really declined. There's a lot of stresses in the financial system. And the first thing the Fed did was it lowered the target range for the Fed funds rate down to near zero. So it pushed short-term interest rates down to zero. It instituted a lot of emergency programs to stabilize the economy, and it stabilized the economy. But it was such a bad shock that the U.S. economy went into a recession. And so what could the Fed do to try to get the economy out of the recession when it already pushed short-term interest rates down to zero? Well, it started conducting what is now called large-scale asset purchases. So in these large-scale asset purchase programs, it would actually purchase a lot of securities from the public. By purchasing these securities, it's pushing the price up. Price goes up, interest rates go down. So it's pushing down longer-term interest rates. So now it had its short-term policy rate near zero, and with the large-scale asset purchases, also pushed longer-term interest rates down. Now, when they did these purchases, the way it would buy the securities and pay for them is it would put funds into banks' reserve accounts. So it was actually boosting reserves in the banking system. So you can see in this chart on the bottom that reserves went from near zero to over $2.8 trillion of reserves in the banking system. So this helps get the economy back going. But then the question is, well, how are we going to move rates when we have so many reserves in the banking system? Okay. And so in the next slide, you'll see a comparison of when it came time to lift off rates in December of 2015, what was the Fed looking at? Well, on the left is the chart that Scott showed you. Right, on the left is limited reserves when the supply curve is intersecting the demand curve in the downward sloping portion. And the key with limited reserves is you can shift that supply curve a little to the right, a little to the left, and it will affect the Fed funds rate. But where are we at liftoff with 2.8 trillion in reserves? We're actually over on the right diagram. You can see in the right diagram, the supply is so abundant. At the time, some people called it super abundant level of reserves. It's intersecting the demand curve on the flat portion. And so if you try to shrink reserves a little bit, shift that supply curve to the left, a little move is just not going to do anything because you're still on the downward portion of the demand curve. And so the Fed had to turn to new tools at that time. And it actually, at that time, used those tools, and that's what it's still using today. So the next slide shows you kind of in a nutshell, what are these tools? Okay, so you'll see the downward sloping demand curve, but we're now operating in what's called an ample reserve regime. Ample reserves means that the supply curve is far enough to the right in this diagram that it's at the flat portion of the demand curve. So small movements in supply are just not going to change the Fed funds rate anymore. So instead of using that quantity or supply of reserves in the banking system as the key tool, we're now using interest rates, which you now see on the y-axis. And so these three green arrows are highlighting three administered interest rates, meaning interest rates that the Fed sets. The top one, the discount rate, was there before the global financial crisis. That's what banks can borrow at, right? If there's stresses, they can come to the Fed and borrow the discount rate. And as Scott said, caps the demand curve. And then kind of two of the key administered interest rates that are probably the ones you want to really focus on in teaching are interest on reserve balances and the overnight reverse repurchase agreement rates. So those two rates kind of help steer the Fed funds rate into the desired target that the Fed wants. So what I'd like to do on the next couple slides is talk about these interest rates. So this slide here just kind of summarizes the key tools, okay? So on the left are the tools, the interest on reserves, the overnight reverse purchase agreement facility, and the discount window. Those three tools in green have associated administered interest rates that we just saw on the vertical axis of the last figure. And then open market operations are still there. They're just not the dominant tool used, but open market operations are still there because the Fed needs to do them to keep the supply of reserves ample or large enough that the supply curve intersects the flat portion of the demand curve. Okay, so now let's walk through each of these tools. Okay, so the first tool, interest on reserve balances. This is the primary tool. So if you have a limited time to teach the Fed's policy implementation tools, this is the key one to focus on. Okay, interest on reserve balances is, well, first off, reserve balances are what banks have when they have excess funds. They could put them at the Fed in their reserve balance account. This reserve balance account earns interest. The interest rate it earns is the interest on reserve balance rate. Okay, so the interest on reserve balance rate is just the interest rate you can think of that banks are earning at the Fed for any of the funds that they park in their reserve balance account. Okay. And this is the key rate that's going to help steer the Fed funds rate into the target range set by the FOMC. Now, how does it do that? There's two key concepts that are shown on the next slide. Okay. You want to think about interest on reserves balances working through reservation rate. That's the lowest interest rate that the bank's going to be able to get. If it has extra cash, what am I going to do with it? I can always park it at the Fed and earn the interest on reserve balance rate. So the interest on reserve balance rate is a reservation rate. Banks will never accept anything less than that. And then there's also arbitrage, that the banks will look around, look at other interest rates, and it can move funds between different instruments and always maybe try to earn a profit. So these are two very important economic concepts. So I'm going to pass it to Scott to talk about each of these two concepts a little bit more. You're on mute, Scott.
You would think after a year and a half, I'd have that down, right? So as Jane said, reservation rate and arbitrage are really the two key concepts for understanding how this works. And they're really the key, concepts that you need to kind of transmit to your students for understanding it as well. So let's take them one by one. The first one, reservation rate. The reservation rate, again, is the lowest rate that banks would be willing to accept. So let's see how the interest on reserves acts like a reservation rate given these investment options. So all of these are investment options for banks. They're all safe, liquid, nearly risk-free options. So one option is they can deposit their excess funds at a Federal Reserve Bank and earn interest on reserve balances. They can lend excess reserves in the federal funds market and earn the federal funds rate, or they can invest funds in treasury bills and earn the treasury bill rate. Now, let's say that there's a difference in what these rates are paying or these options are paying. In this case, you see that the interest on reserve balances is a little bit higher, 2.5%, compared to the federal funds rate and the treasury bill rate. Because banks are seeking profits and the highest return, it seems like this would be an easy choice for banks and that they would deposit their funds at the Fed to earn interest on reserve balances. And this helps understand why that this serves as a reservation rate, right? Again, a reservation rate is the lowest rate that banks are willing to accept for lending out their funds. And so as a result, banks would not be willing to lend their money for less than the interest on reserve balances rate. So the second lesson here, the second concept is arbitrage. Arbitrage will define as the simultaneous purchase and sale of funds or goods in order to profit from the difference. Here on the slide, you see that there's a difference in the two offerings here. So banks are looking at their options and they can see that interest on reserve balances are paying 2.5%, and they can lend their money in the federal funds market and get 2%. So banks will look at this and quickly realize that there's a profit to be had. And so the way this will work is that the banks will borrow in the federal funds market at 2% and deposit at the Fed at 2.5% and earn half a percentage point or 50 basis points on the difference. But of course, the single bank that you see here isn't the only bank that will see this opportunity. Other banks will see this opportunity as well. The increase in demand for funds in the federal funds market will push the federal funds rate higher. In fact, this process will continue until the opportunity to profit disappears. And over time, these two rates will equalize. So arbitrage really ensures that the federal funds rate doesn't fall too far below the interest on reserve balances rate. It works the other way too. So here's another scenario. And in this scenario, the federal funds rate is higher than the federal funds rate or the interest on reserve balances rate. And banks will also see an opportunity to earn a higher return here as well. And so in this scenario, banks would withdraw funds from their reserve accounts and deposit or lend, I'm sorry, in the federal funds market. And again, they would continue this as long as there was the difference between these two rates. But as they did so, the increase in the supply of reserves in the federal funds market would eventually pull the federal funds rate down. And this process would continue again until these two rates became equal. So the key point here is that arbitrage ensures that the Fed can steer the federal funds rate by adjusting interest on reserve balances, because arbitrage will basically reduce or eliminate any difference between the two. So if the Fed were to adjust the interest on reserve balances, arbitrage would make sure that the federal funds rate would adjust likewise.
So this slide kind of summarizes the key concept you want to get across to your students, which is at the top panel, you'll see it says when the FOMC sets a target range for the Fed funds rate, then the Fed's going to choose a level of the interest rate on reserve balances to encourage the Fed funds rate, as Scott just walked through, to trade within that target range. And so then the bottom panels give you an example if the Fed's going to increase rates or decrease rates. So let's take the panel on the left. And when the FOMC raises the target range for the federal funds rate, typically what it does is then the Fed raises the interest on reserve balance rate to encourage the Fed funds rate to move up. So this is the key kind of concepts we would want you to teach to your students. On the next slide, you can see that this tool is doing a really good job over time. So what you can see here is from 2015 to the present, the gray region is the target range the Fed has set for the FOMC. So you can see in 2015, the target range was near zero. So these are basis points on the y-axis. So the gray region on the left is 0 to 25 basis points, or 0 to 0.25, or a quarter of a percentage point. So the gray region was near zero. Then as we kind of came out of the recovery of the great financial crisis, they started raising rates numerous times over the next several years. Okay. Then there were some pressures in foreign economies that the Fed started lowering the rates over time. And then you can see at the very right, the COVID shock hit and the target range went back to zero. So over that time when the Fed, let's look at the left side where policy rate was rising, the gray region was stepping up. You can see that every time they raised rates, they raised the interest on reserve balance rate. That's that dotted line. And early in 2015, it was at the top of the target range. And you can see as each time it raised the target range, the gray region, the dotted line moved up the same 25 basis point increments. And the Fed funds rate, which is the solid line, continues to move inside that target range. And then on the right-hand side, when they lowered the policy target range, the gray region, they lowered interest on reserve balance rate, and the Fed funds rate dropped down again within the target range. So this tool is doing a really good job at keeping the Fed funds rate, which is the market determined buying and selling of reserves in the banking, basically between banks, in the target range that the Fed set. Okay. So this next slide, if you have time, the next tool we would like you to talk to about with your students is kind of what we would say is the supporting tool to interest on reserve balances, which is the overnight reverse purchase facility. Now, interest on reserve balances is only available to depository institutions, and an easy way for you to think about is the banks. Okay? But over time, there's been many other large financial institutions that play a role in financial markets. And so the overnight RRP facility is introduced to a large number of other big financial institutions. So besides banks, the overnight RRP facility works just the same way for these other institutions. And you can think of them primarily as money funds. So the money funds who have a lot of cash that like you might have some money in a money fund, large organizations like grocery stores, other big organizations that need cash sometimes put money in money funds. When they are trying to decide where to invest in, one of their options is they can come to the Fed and deposit it at the overnight RRP facility. When they deposit their funds at the facility, they will actually get a security, a treasury security as collateral. So this facility is overnight, and it includes having a security transaction as collateral in the background. It works again with reservation rate and arbitrage, as Scott mentioned before, but now with these new, these different financial institutions. Okay. On the next slide, you'll see the third tool, which is the third tool in our diagram on the y-axis, which is the discount window. I won't spend much time on this because the discount window was available before the global financial crisis. So it's just set, though, instead of having banks deposit funds with the Fed, it's actually a lending facility and gives banks funds in times of stress. The discount window has many rates. The most common one is the primary credit rate. Yep. And then the next slide, you can see that here, when Scott was showing how the limited reserve regime worked in the past, here's an example of how the Fed would raise rates in an ample reserve regime. So key is we have the downward sloping demand curve like before. The supply curve now is very far to the right on the flat portion of the demand curve. Now, when the Fed goes to raise rates, look what happens to supply curve. Nothing, okay? The supply of reserves is not changing. The Fed is not doing an open market operation. Supply of reserves is staying the same as before. But what is changing is everything on the y-axis, all of its administered interest rates. So when the FOMC says, okay, we're going to raise the target range for the FOMC, for the Fed funds rate behind the scenes, and to implement that policy and make sure that they go through into the market interest rates, it raises interest on reserve balance rate, the overnight RRP rate, and the discount rate. And you can see in this animated graph that when it raises those rates, it's shifting the endpoints of the demand curve. Now, it's banks will be willing in the market to pay more for borrowing because the discount rate just went up. And on the x-axis, now the reservation rate that it's willing to receive any funds it lends is now higher. Okay, so that shifted up the kind of the right end of the demand curve. Okay, so again, interest on reserve balance is the primary tool. It helps when you increase that, it increases the reservation rate, it pulls the demand curve up, and along with that, it steers the Fed funds rate up. Okay. On the next slide, I wanted to mention open market operations. That was the primary tool that Scott spoke about in a limited reserve regime. Again, as I emphasized that it's no longer the primary tool, the supply curve was unchanged in that last figure, but they are still, the Fed still uses open market operations. There's some external factors that can change the supply of reserves. If that supply of reserves starts to shrink too much and you start getting towards the slope of the demand curve, the FOMC would, the Federal Reserve would say, hey, we need to boost the supply of reserves. How would we do that? The Fed would go out and purchase securities and then pay for them by putting some reserves in banks' reserve accounts. Okay? So open market operations are still there, just not the primary tool. And then the last tool I wanted to mention is reserve requirements. And that's because reserve requirements were used before the global financial crisis to help keep a downward sloping demand curve. Banks needed reserves to meet their reserve requirements. But with ample reserves in the banking system, they have ample reserves. So reserve requirements are not a significant tool anymore. And as a result of that, last year in March, reserve requirements were actually set to 0. So now reserve requirements are just not a tool. So you should not be don't even need to talk about those in your classroom anymore. Okay. So just to summarize, what are the key tools? The 3 in green are the kind of 3 tools that have associated in parentheses, the 3 administered interest rates that are help guiding the Fed funds rate, and open market operations are still there. They're just not the primary tool anymore. Okay, Scott, with that, let's go back to the poll.
So let's redo our poll. We'll ask again, what is the Fed's primary tool for influencing the Fed funds rate? So A, open market operations, B, discount rate, C, reserve requirements, or D, interest on reserve balances. And you people are sharp.
Hey, students.
I'd say. All right, we're waiting for a few more people to cast their vote. All right, so there are the results. 100% of you said interest on reserve balances. So in the pre-test, 35% said interest on reserve balances, and post-test 100%. So good job, you are exactly right. So let's talk a little bit about teaching. So our teaching recommendations on how to cover this would be, first of all, focus on the Fed's administered rates. So these are the rates that the Fed sets directly that Jane covered: interest on reserve balances, the overnight reverse overnight reverse repurchase agreement rate and the discount rate, with which, of course, if you're going to focus on one, interest on reserve balances rate would be the one to pick, since it is the primary rate or the primary tool. Also, teach reservation rate and arbitrage as the key concepts. So we've had a few conversations about this, both with each other and with others, is that these concepts, I think, are actually easier for students to grasp than open market operations were in the old regime, right? So I taught high school economics for a long time, and explaining how the Fed used open market operations to shift the federal funds rate is really kind of an abstract idea, and there are a lot of different steps the students have to understand to get there. In many respects, this is an easier process, right? So the Fed uses interest on reserve balances, it controls that rate, assess that rate, it shifts that rate up and down, and through arbitrage, that causes the federal funds rate to shift up and down with it. Talk about how the Fed can steer interest rates. Number three, refocus monetary policy discussion away from how the Fed influences the money supply and tools, right? So many of our textbooks are built on this whole money supply, framework. You have your money and banking chapter, and then you have the Federal Reserve chapter, and it's all about how the Fed, influences the money supply to influence the broader economy. And while that may have been accurate, a few decades ago, really policy decisions are focused on interest rates. And then number four, link monetary policy to aggregate supply, aggregate demand. All that, usually that's a pretty standard framework in your textbook, and it's easy to transition from interest rate changes to how that affects aggregate demand. We really like the flow model that we've introduced at the bottom. In fact, almost everything that we've written for teachers in the last year has included this way of thinking, where you have box one, the FOMC sets the federal funds target range. This is the Fed conducting monetary policy. We make a distinction between the Fed conducting policy and the Fed implementing policy. So box one is conducting monetary policy. That's the FOMC setting the federal funds rate target. And then the red arrow is the implementation. So this is where the Fed uses the tools. So most of our discussion in this presentation is about what happens with the red arrow, right? How the Fed implements the policy to steer the federal funds rate into that target range. But then you have 2, 3, and 4, right? So box two, the federal funds rate and how that affects rates overall, other short-term rates, and other rates throughout the economy and overall financial conditions. And number three, how that influenced the decision-making process. So this is a really good way to talk about economic literacy and the fact that it's all about consumer and producers making decisions. And then box four, how that moves the economy towards the Fed's dual mandate of maximum employment and stable prices. So the question, have teaching materials stayed current, right? So one of the struggles with teaching new content is what kind of support you're getting from your other teaching materials. When we started writing, we quickly realized, or actually we kind of knew it going in, that teaching materials were not reflecting how the Fed was implementing policy. And to kind of show that, we evaluated 6 popular college textbooks, introductory level college textbooks. They all had copyright dates of 2020 or 2021. And we looked at the key topics of monetary policy, such as the policy rate, the policy tools, and how the Fed adjusts those rates. We found a wide dispersion on the coverage. We used a rubric, and we kind of came up with the key thoughts and ideas, concepts that should be addressed when discussing monetary policy. We came up with this scoring rubric, and then we went through those 6 textbooks and scored them. This is how it all panned out. So you can see that half of the books actually got a negative score, and half got a positive score. the Stevenson and Wolfers book, we like to note, was a first edition textbook. It didn't have kind of the baggage of having previous editions to deal with. They could start with a clean sheet of paper and write their monetary policy chapter about what the Fed currently does. All of the other textbooks had previous editions, and we've done a little writing as well to talk about some of the obstacles to updating. But in any case, um, I guess the punchline is that your teaching materials are not so far supporting your teaching of this process, but we're hoping that that changes, and we have had some conversations with textbook authors, and there is a desire to move the ball down the field on this one. Um, we do want to talk a little bit about ways that we can support you as you make this transition. We have another event coming up at the end of August, August 26th. This is a webinar, so it's another virtual event. Sometimes more than one exposure to a concept is good. Also, this is right before the school year, so it might be a good refresher right before you go back to the classroom to kind of revisit this information. So we invite you to attend this webinar as well. But we have been really busy trying to develop materials to support you as you go into the classroom. In fact, we've developed an entire web page of different articles and classroom resources, and we will continue to add resources to this web page. So we're hoping this is kind of a one-stop shop or an early stop that you have in your search for good in the way you teach monetary policy. I want to highlight 3 different resources that we've developed that I think are especially useful. This one is a page 1 economics we wrote last year, the Fed's new monetary policy tools. It's relatively short. It's really intended for teachers and professors rather than students, but it really explains and goes over a lot of what we talked about today, but probably in a little more detail. But it's a good overview to read and think about as you consider updating your teaching. Another one here, this is a lesson plan, or we're calling it a lecture guide. It really is kind of a step-by-step, almost like a script on how to teach this. If you want to lean on this particular resource, it comes with slides, so you can download our slide deck that goes with this lecture guide. In fact, a lot of the slides that we used in our presentation today are edited versions of those slides. It also comes with a study guide for students. So as you go through the lecture guide, your students can be filling out the study guide, which has a lot of graphic organizers. It's not just copying things down, but it forces students to kind of think about and apply some of the concepts that you're talking about as you're going through it. The last thing is really kind of the most hands-off approach that you can take. So if you want your students to have this content, but you don't feel you're ready to tackle it in the classroom, or perhaps you don't have time to fit it in, but you want to have your students exposed. This is an online learning module that we have in our Econ Lowdown learning platform collection. It's one of about 500 teaching resources, but it goes over all the essential content. It's got checks for knowledge, a pre-test, the post-test. If you're already using Econ Lowdown, add it to your syllabus this semester, and it does a good job of covering the key content in engaging ways. We kind of pitch this toward kind of that, upper level high school, introductory college level student. And don't forget that we do have a website at the St. Louis Fed where we have a lot of teaching resources. All of them are free. In fact, page 1 economics is one where we're writing about a lot of these issues. Page 1's on this topic. We have a few more in the pipeline of related topics, so make sure that you check out page 1 economics. In fact, you can subscribe. If you go to our website and you click subscribe, you can subscribe to our email list, and every time we come out with a new issue of page 1 economics, we'll send you an email alert. In fact, one of those alerts went out about 10 minutes ago for an article that Jane and I and another colleague wrote about inflation. So you may, if you're a subscriber, you may have just received the one earlier today. I also want to invite you to the St. Louis Fed Professors Conference. So this is something you can share with the teachers that you work with on a regular basis, but it's also for you. So we have a great conference planned. It is a virtual conference again, so whether or not you want to travel to St. Louis, we'd love to see you in person, but this year we'd love to see you online as well. Our keynote presenter this year is David Aldafato, who is an economist here at the St. Louis Fed, and he's going to ask the question, does the national debt matter? Okay, so not how much debt, but does it matter at all? And he's an engaging speaker, and I think that'll be a great session. We do some time for questions, I think.
So Scott, I was actually looking at the chat while you were talking, and some really good questions came in. So, as people were listening and realizing reserve requirements are no longer a key tool, they were thinking, well, what does that mean about teaching the fractional reserves kind of regime? And that's exactly what the limited regime that Scott started with, that's what that was. That was the fractional reserve regime where the Fed was operating on that downwards portion of the demand curve. And so what we're trying to say is that you don't really want to teach that anymore. If you look at kind of the way that teaching went, there was always a chapter in a banking chapter that talked about the money multiplier. So now you really don't want to lean on that money multiplier and the reserve ratio anymore. In fact, sometime soon, hopefully within the next month or so, we have a piece. First questions we get is, what about teaching the money multiplier? And our comment is always, you don't need to teach the money multiplier anymore. That's not true. That's not what's happening anymore. The money supply is quite large with reserves in the banking system being ample. And so this piece that's going to come out is going to try to have you think about banks as just what are some key things that banks do without talking about a money multiplier. So that's just a little bit of answering a question here, which we've also heard in the past, and kind of highlighting this piece that will be coming out shortly about how not to teach the money multiplier, but instead lean on different concepts.
It looks like Jack has had his hand up for a bit, so I know that he may have a question, and then there was a few other questions in the chat that we can give some time for. Jack?
Yes, I'm not sure if this is necessarily the place for this question, but it's been something that I've been concerned about since last March, to be frank. And that is the prospect of cost push inflation, where the effect of shutting down the economy, we had basically an aggregate global supply shock. And I'm not seeing huge effects of this. Nothing like we saw, for example, in the 70s when OPEC cut production of oil. That's effectively what happened in this case as well, just the production of, well, just about everything. So my question is, do these new policies, is this why we're not seeing really, I know a lot of people are still talking about inflation's coming, it's getting worse, it's getting worse, it's getting worse, and maybe it will, but are these policies, at least in part, the reason why we haven't seen that at least as bad as some are predicting? Does that make sense?
You want me to take it, Scott, or would you like to take it?
You go ahead.
Okay. Well, actually, Scott mentioned an article that just came out today, which is actually on the Phillips curve. And so back time, the OPEC and the oil crisis you were mentioning, it's true, we had really high inflation. In part then, we really believed in the Phillips curve. Inflation today is what inflation was yesterday, plus any gaps in output gap or unemployment gap and stuff. And if you kind of follow the Fed and what the chair says in monetary policy testimony, I would say this goes back to even when Chair Yellen really favored this, where she said, we could really push for lower unemployment without a lot of inflation because things had just really changed. I think if you were a price expert, Scott and I were working with a price person in this piece that just came out today. And what she would tell you is that inflation has just become much more anchored than in the past. Well, what does anchored mean? It means that people, when they go to try to bargain for a salary increase, or when firms try to set price, they really the goods very much, or you're not going out and trying to get too much of an increase in your wage the next year. And so because of that, now this Phillips curve is just very flat, or just, Scott pulled up the article that just came out today, the prices are just not, you're not seeing them as linked as in the past to, say, growth in the money supply. So back in like the 70s and 80s, actually, Congress had the Fed set money supply targets, growth of the money supply targets, because back then it was believed there was a big link between growth in money supply and growth in the economy. And that relationship just broke down over time. And so then the Fed started targeting the policy rate. And then it thought that inflation was related to economic activity. And I think we still do. We just think that linkage is much weaker than it used to be. So hopefully this article that Scott put up should help a little bit. Now, that said, we saw a lot of inflation over the past couple months. If you listen to kind of commentary coming out of the Fed, a lot of Fed officials will say it's transitory factors. But I kind of feel like that's deviating from today's discussion. So, maybe take a look at this article Scott's showing, and that can help. But hopefully try not to link the inflation argument too much to the change in the policy regime that we're talking about today. Today, we're just talking about if the Fed, the FOMC comes out and says, I want to raise rates, I want rates to be a certain amount, I want to cut rates, I want them to be a certain amount. How do they know that market rates are going to move when they say that? And it's these tools, interest on reserve balance being key to teach your students. That's how they kind of know that market rates are going to move.
Thank you very much. It is becoming clear that the things that I'm teaching in my class are not necessarily accurate anymore. 10 years ago, in some cases, it sounds like maybe 20 or 30 years ago, it was more accurate. So this is really useful to know. And I sure hope that our economic course material catches up to the reality, because I was looking while y'all were talking at my McConnell, Rue Flynn material, and they still talk about open market operations in their slide presentation is the most important one. So that was really disappointing, because that is a new edition that just came out last year. That's absurd to me. All right. Thank you all very much.
Yeah, you're welcome.
We also have quite a few questions from Christine, and I thought if she wants to unmute and ask she had several. So maybe Christine, if there's something specific that's burning that you want to ask that. Before you do that, Scott and Jane, lots of questions about the slide deck presentation. We are recording this whole session, but they want to know if the slide deck presentation will also be available.
Yeah, we're happy to make the slide deck available. And as I said before, a lot of those slides are also available as part of that lecture guide that we developed. But as far, I think Jane is in agreement that we're happy to share the slides as well.
Yeah, and I just want to chime in on that slide deck that we created as for teachers. I kind of thought, wow, when I used to teach, I wish I knew about like some of these resources that the St. Louis Fed has. And this slide deck, I mean, we spent a lot of time in it, and it's very similar to things we have here, but we have like bullet point on this slide, say this, emphasize this, try to get this point across. And I hope you would find it as a really good resource. So please take a look at that kind of lecture guide for you. And we even give ideas of where you can stop your lecture, so you don't have to use the whole thing. You could just focus on certain material, and I think you can pick and choose the slides you would like to present.
Christine, go ahead.
Well, I think I sent to Jane a note warning that I was a student of Milton Friedman's, so I am a monitorist. So maybe this material is more along the lines of something that we would want to talk about another time. But the questions that I had asked were about money supply, and how do we now define that, and how can we easily really, I teach with the quantity theory of money, and how can we relate the quantity of money to inflation?
So I think you could still use, the velocity velocity of money story. The velocity just has changed a lot. Again, like we don't think when you talk about banking system, you don't talk about the fractional reserves, don't talk about the money multiplier. That's just not the way the Fed thinks about it anymore. It's just a very different environment. And you can just look at the picture that we showed early on, where when we were in the great global financial crisis, and the Fed had to purchase a lot of securities, and reserves just increased tremendously. The money supply rose. Again, that's been happening over the past 2 years with the Fed doing a lot of open market operations or large scale asset purchases again because of the COVID. And you're just not seeing inflation like you used to. So I think you want to rethink the inflation and how it evolves, or how people think about inflation, the idea of it being anchored or not anchored. So again, I think we're kind of moving away from quantities and money supply and more towards interest rates, if that helps.
It does, but you go back to, we always thought or taught, and I believe that the velocity of money has been relatively constant. So are you saying that the way the Fed is now conducting policy that has somehow made the velocity of money much more variable?
No, I'm not saying that at all. I'm saying that I think if you plot kind of a diagram of money against, say, real output, you'll see that the velocity, I think you'll see over time, you'll see that the velocity has changed over time. So I don't think people will think the velocity of money is constant anymore.
So it has with these new policies become much more variable, which is what would have had to have happened in order to have not very little inflation.
Well, I don't think I would point to it as being these new tools. I think it happened before the global financial crisis. I recall when I used to have to forecast the money supply in one of my jobs. It was just really hard to do. And the old tools or models that staff at the board used, and say like the 80s and 90s were just not working anymore in the early 2000s. So it's just a different world, and different factors have changed over time.
Thank you.
So we had a lesson that I actually wrote not too long ago that was about, it used an inflation auction. We talk about, increasing the money supply, and you do this activity and you get this inflation. And I recently tweaked that lesson so that it was more, instead of like too much money chasing too few goods, I tweaked it so it was too much spending chasing too few goods. So it wasn't just, I think that's maybe one of the hurdles in teaching this at an introductory level, is that the level of reserves sitting out there is money, but it's really the spending relative to the capacity that in my mind is a good way to talk about inflation with students.
So is that money just not circulating?
Right. So Jane can probably add a finer level to this, but when we talk about reserves, reserve balances are really high, and that's a function of this new regime, right? It's just the ample reserves regime. So it's designed so that there are more reserves in the system.
And I think that's kind of why you don't want to do the money multiplier anymore. So the idea of the money multiplier was somehow banks were constrained. The Fed only gave them a certain amount of reserves, but then they wanted to make a profit and lend, but they had to meet these reserve requirements. That's just not the story anymore. So reserves are ample. Banks have enough, so it's really this, like Scott said, I think he had a good idea, which is kind of think back more to the spending. Reserves are just like, you have cash in your checking account, right? So it's not that you have currency in your pocket, a dollar bill in your pocket. You have this electronic money at your bank. It's sitting in your checking account. That's exactly what reserves are for banks. So the Federal Reserve is the bank's bank, and the banks have a checking account, which is their reserve bank. And so the reserves they have are electronic deposits, just like you have electronic deposits in your checking account.
So are the commercial banks reserves with the Fed, are those reserves included in M2? Or are they included in the money supply? The bank's reserves, which would in the past been included in the money supply, but if they're now being just left at the Fed, are they included in the money supply? Another way, we start this by saying we start the whole section by saying what is money, and then we have not gotten in there the bank's bank in the past. So maybe we need to put that in. What is money?
So there's various measures of money. They are in the monetary base, but they aren't in like M1 or M2.
Okay, that's it. So they're in the monetary base. Okay, that's it. That's the difference. Got it. Thanks.
Fantastic. So as we approach the end of the session, I did put a survey link in the chat if you guys would love to give us your feedback and take a little time to complete that evaluation. I know that Jane and Scott certainly would appreciate it. If there are any last questions, we've got about 2 minutes. Feel free to unmute and ask that, or Jane and Scott, if you have any. Jan looks like she has a hand up. Jan, you want to go ahead and ask your question?
Yeah, the things that we are encouraged to do at Wichita State is bring the international component in. And so, so I'll look and see, so what's China doing, what's India doing, what's any other country doing? And you see a lot on, China just cut its reserve requirement, blah, 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 blah. So are other countries still using the Fed's old tool? I mean, what do I say when the students say, well, are they still using the same old toolbox the Fed did? Heck if I know. But it looks like they are. Do you know? What are they doing?
So China definitely does, and China just changed their reserve requirements recently to try to encourage spending. So the old toolbox, if it's being used, is used, you might say more in kind of the emerging market economies, but the advanced economies like Bank of Canada, Bank of England, Bank of Japan, ECB, they are all using kind of a similar regime as what we are. And in fact, many of them were using this regime before the global financial crisis. And the Fed was trying to decide, what do we want to do? Do we want to stay with our old limited regime? Do we want to make any changes? And there was a big conference at the Federal Reserve Board in Washington, D.C., and they invited the foreign central banks in, and they started thinking about this, like what are the pros and what are the cons? And then the global financial crisis hit and kind of put that on the shelf, and kind of, in some sense, Scott and I kind of said that kind of forced their hand into thinking about it and moving to the ample reserve regime, which probably, they probably might have done that anyway. I mean, they were already starting discussions. Most advanced foreign economies already were doing that. There's a lot of pros, I think, now that we've been using it. I think there's a lot of pros, and they had two discussions over the past decade about, do they want to go back or do they want to stay where they are? And they, in the end, in 2019, put out a statement saying, we're in the longer run, we're going to stay with this regime.
Thanks.
That looks like one last question from Ann Kramer. Hands up, but I'm not sure she's.
Yes, sorry, don't have a camera right now. Hi, Scott, and hi, Jane, and everyone. I'm just wondering, I understand that that what you're saying about the tools of the Fed changing. Do you think that means that the critique of the Federal Reserve is changing as well along with it? I understand, empirically speaking, we're not, with the increase in the money supply, we're not seeing a lot of inflationary, concerns. But in terms of the critique of the role of the Fed, do you think that that's changed along with these tools, or is it pretty much stayed the same?
Well, that's a really loaded question.
Yes. Sorry.
I think there's always critics of the Federal Reserve. There's going to be, but it's in multiple avenues. In terms of monetary policy, which we're talking about, I think the Fed has gotten a lot of kudos from Congress over the past year for the response to the COVID. Now, we're kind of we're starting to improve. There's been a lot of chatter about what's the next step of the Fed and when are they going to react. So I would bet, over the next 2 years or so, as kind of the economy is improving, there's going to be a lot of chatter or critics saying the Fed's doing things too fast or too slow. And so I think there always will be critics. But, when there was a severe crisis and the Fed came in and kind of pushed a lot of kind of easier monetary policy to help stimulate the economy and help households, I think there was a lot of positive support for the Fed. So now that we will eventually, hopefully things will keep improving and we'll have to get back to normal, I think there'll be more critics talking about, are we doing things too fast or too slow in terms of monetary policy?
But what about not doing things at all? So
Well,
well,
I don't think they can
leaving
point to
it alone altogether.
I don't think they can say that the Fed did not do anything during the COVID. I mean, if you look at the Fed's balance sheet, it ballooned, and the Fed's balance sheet shows like all the different programs they instituted. Some of it with Treasury, we had to get agreement with Treasury to do some of these programs, but the Fed did a lot last year. And actually, Scott and I have an article on that too.
No, I of course I know that, and thank you so much. I'm meaning the critics that are saying that the Fed should not take any role at all and allow more of the invisible hand and just price signals to be guiding, sort of more of the Austrian ideas. And I'm just wondering, when it comes to, sort of this idea of the Fed comes in, the Fed increases the money supply, drives down interest rates, that creates a whole, sort of that Austrian critique, of how then it leads to, more problems down the line. So just that perspective of that the Fed, really the best role of the Fed is to do nothing. And of course, whether obviously you're not agreeing with that, but I'm just wondering if you think that these new tools have changed that perspective, that the Fed still should not be doing anything.
So I guess I don't think I have enough knowledge to comment on that. I think that, as Scott said from the beginning, the way it conducts monetary policy, setting interest rates, has not changed. And then these tools that we're talking about are just kind of the behind the scenes tool happens. So I would think the critiques you're worried about probably wouldn't change based on what we're saying. But that's just my initial guess.
That's what I thought. And I just wanted to confirm that. I don't know if you agree with that, Scott, but that's what I was thinking as well, Jane. So thank you for saying that.
Thank you so much, all. It is 1 o'clock, and I love that we had such a great response to this session. I want to thank Scott and Jane. This was they brought it to us and said, hey, teachers need this. So thank you so much. If you have other topics you'd love to see in the NAEE PD, I put my email in the chat, and love to see you guys at future PD. So Jane, thank you so much. Scott, thank you. And just fantastic information.